Morning, everybody. Apologies, I didn't realise we'd actually gone live yet. It's the first time using this software. So, if you're unfamiliar, my name is John Bloomfield. I am an independent financial advisor at Bloomfield Financial, and I've been doing this sort of thing for 20 odd years. So today's session, we're just going to talk about the budget and how it will impact people from a financial planning point of view, rather than just going through all the detail again that you've all seen previously on the news, etc. So we suggested we use this format, and we do a lot of deep dive webinars for clients, etc. Somebody suggested that we try YouTube Live instead. I'm not sure if we will use it again for deep dive webinars anyway, but if you're interested in those, there's a link in the description box below this video where you can get notified of when those are, because they're held in private webinar rooms usually, because often people ask questions and I answer them off the cuff, and for legal reasons I need to make sure that I can keep the answers in context, which I'm not sure I can do on a live YouTube stream, but we'll have to look at that to begin with. So I've gone through the 168 pages of the budget to try and pull out the things that I think are most relevant to a lot of people as far as a financial planning perspective is concerned. I'm not going to take things on a political view, as in whether it's good for the economy or what they should do or what they haven't done, etc. like that. That's not the purpose of what we do as financial planners, financial advisors. I'm going to hit on the points that I think are relevant to our clients generally, who are generally individuals and companies, and things that you can think about to optimize your own financial plans in line with the budget. So on the run up to the budget, this is sort of an aside, but I think it's quite an important thing. We made no comments about all of the rumours in the press, etc., to our clients or to anybody about what was coming up in the budget and whether they should be taking preemptive action. The reason for that is I strongly believe that you should act on what you know, not what you think is going to happen. You could make some disastrous financial mistakes based upon rumours, particularly where things like the budget and stuff are concerned. Anecdotally, I've heard from other advisors of people who, heading up to the budget, because there was rumours in the press that the government were going to remove the 25% tax-free cash allowance on pensions, went and withdrew large sums from their pensions, incurring large tax bills in order to protect their money. And that didn't happen. So big financial mistakes can be made. And we certainly had phone calls from clients who wanted a bit of reassurance on this and whether they should be doing something. And people we'd never met as well, actually. Now, we didn't put anything out to say don't do this, because as a financial advisor, it's my belief that we can put all the numbers and things in place for clients, and we can explain everything that they possibly need to know about a situation. But clients aren't machines, they're humans, and we all behave differently, and we can understand the logic of something, but we don't necessarily act in logic. So I spend quite a lot of my time these days studying human behavior, behavioral psychology, behavioral economics, to make sure not only are we laying out for clients the best way numerically to do things, but a way that will succeed for them, and that we can come up with alternative strategies for clients that things don't work for. Now, part of that is there is a phenomenon where if you tell somebody not to do something, even if they've never thought about it before, a certain percentage of people then will suddenly start thinking about it and might do it. So from my perspective, I feel like speculation and even downplaying things like saying don't do this or don't consider doing this can be counterproductive, in that it gets people to take actions that they might necessarily not be wise, and even telling them not to do things, they might take actions that wouldn't have even crossed their mind if we hadn't said anything about not doing it. Good example is if you out with a child and you tell them don't look into the sun, it'll make you go blind. You can almost guarantee 90% of children will try and then look at the sun, but they would never have thought to look at the sun in the first place. So if we said to clients, don't panic about the removal of the 25% tax-free cash rule, we don't think it's going to happen. We know historically that when the government makes significant changes to pensions that have negative effects on people who've used their pension in all good faith for its real purpose, to provide for their retirement, that there's always some sort of protection put in place. Some people would have then immediately thought, well, they wouldn't be talking about this unless it was actually a possibility, so we should do something now. So with that being said, we'll move on to the things that I think most people should take consideration of in the budget. But a little bit of legal stuff that I need to mention first. It's all obvious, but because we're regulated financial advisors and not journalists or just pundits, we have to point out to you a few things in order to protect ourselves, as it were. First of all, we are regulated financial advisors. The Financial Conduct Authority do not regulate everything that we discuss in this video or generally that we deal with, so tax advice, estate planning, certain types of commercial lending are covered. It's kind of obvious, but the content of this broadcast is aimed at UK residents. But the main thing is nothing in this stream should be taken as personal financial advice. It's just information to consider. If you do need advice, speak to us. I mean, we do a free initial consultation. We can have a quick chat with somebody, or unless we're a qualified advisor that you might be dealing with. Obviously, if you're already a client of ours, then definitely speak to us. But with that being said, let's move on to the content of the video, the thing that you actually tuned in for. So, I apologise that I'm going to keep looking down because this is only a couple of days ago. I am using paper notes rather than any sort of presentation software or anything like that to cover things. So one of the things that I think is worth noting, which is not a direct thing, is that within the budget, HMRC are receiving some additional resources to deal with fraud. 5,000 new employees, digitisation of systems in order to prevent double ISAs happening and not being noticed for years, child benefit being dealt with properly, and simplified administration of third-party data. And this, I think, will lead on to improving the way that they monitor pensions annual allowance. If you're not sure what pensions annual allowance is, if you look on this channel on the webinars playlist, we did a deep dive webinar a little while ago when we covered it. But essentially, at the moment, if you go over the amount you're allowed to pay into a pension and get tax relief on it, you are expected to self-report that via your self-assessment tax return. The HMRC will manually inspect people who they think have gone over or might have gone over, but there's no automated system to catch everybody and deal with them directly. Providers like pension companies do write to HMRC and to members and say, we think you might have gone over. That's the third-party data. So I think it's only a matter of time before that sort of system catches up and it becomes easier to deal with, but equally, if you think you might have an issue and you haven't been dealing with it, you're much more likely to get caught up with. I mean, I think you always get caught up with anyway, but it's more on the cards. I mean, one of the big things coming out of the budget was the freezing of personal allowances. So capital gains tax allowances frozen, income tax allowances frozen. This has a bit of a knock-on effect in that it raises money for the Treasury, in that as inflation, etc., pushes up pushes down the value of the pound, and wages rise, pensions rise, etc. More and more people pay tax because their allowance of what they're allowed to have tax-free is reduced. Capital gains tax is a big one that they've been squeezing that for quite a few years. Ostensibly, it's aimed at people who make their wealth from assets rather than from earned income from their labour, as it were. But it does hit everybody else who's got investments, etc., that are not necessarily in an ISA or in a pension, savings plans and things, investment savings plans rather than savings plans. And for a lot of people who are doing pension drawdown, a lot of people operate the strategy of drawing off the difference between their state pension and their personal allowance every year in order to maximise their tax-free allowance. Obviously, that was going to reduce drastically over time the amount that they have available in that gap if their state pension is their only regular income, because the state pension, of course, rises in line with a couple of different things, but inflation essentially is the whole point of it. So that gap will be squeezed, meaning more withdrawals from pensions will become taxable. And IHT, the allowance has been frozen now. Only a very small percentage of people currently pay IHT from their estates, but that, I think, would rise drastically based on a couple of changes that are in the pensions. Sorry, that in the budget in relation to pensions, but we'll come on to that later. So if we go through this via sort of, because we take it from a financial planner perspective, we talk about different areas of financial planning. So investments, ISA allowances remain unchanged. Capital gains tax, that's the big one that we need to be aware of. So if somebody is come into some money at retirement or at any point in their life and they want to invest it, what usually happens is we'll put as much as we can in their ISAs and we put the rest into what's called a general investment account, which is basically exactly the same account without any tax privileges. It hasn't been used for a pension. Now, when you cash out of the general investment account, the profit that you've made on the money that you put in is subject to capital gains tax. The allowance that you have for how much capital gain you can make each year is now £3,000 per person. And it doesn't accumulate over the years. So if you put £10,000 into a general investment account in now and you wait 5 years and you take it out and it's now worth £15,000, you don't get your £3,000 allowance for all those 5 years. It's calculated on that year, assuming it's still £3,000 then. So it'll be £2,000, which is subject to tax, and the rate of that tax has just gone up quite significantly. So when we did our earlier this year, we did a deep dive webinar for clients on ISAs, which we've uploaded a copy of it to the YouTube channel. One of the things we mentioned there is that if you have both cash savings and investments, and you're choosing which one to use your ISA allowance for, because you can put it against investments and you can put it against savings, we would pretty much always recommend that you use it against your investments, because capital gains tax, it should be a much bigger worry for most people than income tax. There is already a savings allowance amount that you can make on your savings interest free, and that's there for just general deposit accounts and things. So for most people, if you've got to choose where you're allocating your ISA allowance, it's towards your investments. And what we would generally do for clients, and this remains the same going forward, is if clients have ISAs and general investment accounts, every April we will move some money from the general investment account to the ISA. That will usually mean that we're going to create a gain or a loss, and you can strategically choose which things to sell to try and make sure that you stay below the £3,000. So certain funds within the general investment account have done worse than others. You can use those to offset it and get the full 20,000 across, keeping that below the £3,000, and that will reset the clock and get some of it outside of the capital gains tax. And do that every year until eventually you've got nothing left in the general investment account. It's all protected within the ISA. That strategy isn't going to change. Just something that people need to think about, and you should think about it within your own financial planning. And there was something that Jeremy Hunt, I think it was, when he was Chancellor, we had that many Chancellors, proposed the British ISA, which was supposed to be an extra allowance for ISAs, which was going to be only allow you to invest in British companies. From an investment perspective, it was pretty ridiculous, if I'm being frank. We wouldn't advise clients to invest entirely in the UK. As much as you might be patriotic, the UK economy is not as significant as it used to be on a global scale. People do tend, again, this goes back to the behavioural sort of psychology and behavioural economics, do tend to like to invest in their local market because they like to see brands of the shares and the investments that they recognise. Makes them feel more secure, but realistically it reduces diversification. And when you look at the British stock market, actually a huge amount of the companies have very little to do with Britain that are listed on the UK market. So I'm not quite sure how that works, or how they planned that would work in the British ISA. The only disappointing thing is that it was going to be an extra £4,000 of tax-free investment stroke savings you could have per year. That isn't going to happen now. But yeah, as I say, I don't think that the British ISA was ever really a great idea. I could see from the government's point of view how it might stimulate some growth in the economy in theory, but it was going to be a tricky one for us because we always tell clients to maximise their tax-free allowances, but we would have probably tried taking out the British element from their normal ISAs and then using the British ISA to complement it. It would have become very complicated for us, and even more so for a member of the public trying to keep their assets sensibly diversified in the same sort of situation. So pensions, this one is this is a big one really. I'll start with inheritance tax. So from April 2027, so it's quite a long way off. Pensions, the pot that you leave if you're in drawdown or you haven't started accessing your pension, is now going to be subject to inheritance tax. It's going to be included in the calculation of your estate. Now, pensions were never really intended to be inheritance tax vehicles, and what's happened since pension freedoms is a lot of very well-off people have used pensions as a way to, well, protect money from inheritance tax. They place money in pensions anecdotally with the, well, not just anecdotally, I know people have done it, anecdotally with the intention that it will never be drawn on. Put the money in pensions for themselves, for their children, for their wives, for their cousins, for anybody that they can gift money to or feasibly fund a pension for without causing any liabilities elsewhere, just to get outside their estate for inheritance tax. So the government closed that by saying that your pension is now going to be taken into account with inheritance tax. That's going to pull an awful lot of people who weren't doing that, that wasn't their intent or their strategy, into inheritance tax. So for our own clients, when we come into the annual reviews, because we've got plenty of time, it's April 2027, unless somebody's in particularly bad health, we will be looking again at their inheritance tax position and working out strategies for mitigating that now that the pension is going to be taken into account as part of that. The strategies don't really change massively. Here, we really believe that you stay within the white. So, there are you will see a lot of, particularly on YouTube actually, you will see a lot of people talking about tax saving strategies that sort of work between the lines with HMRC guidance. So they're not strictly against the rules, but they're not strictly covered in the rules, and they only really get tested if HMRC decides to take somebody to court over it. We, as a firm, believe that people need to sleep at night, and that's what financial planning is all about, really, peace of mind. So we stay firmly in the white. So the strategies that we will be looking at for clients are pretty much the same as they've always been. My preferred strategy for clients when it comes to their pension and mitigating inheritance tax is just to live a fulfilled life and spend it. Don't hoard the money. Enjoy yourself. I mean, my personal philosophy, there's no point in living in poverty. Just leave some money to the next generation when you've got assets there that you could be using. But that's not going to be feasible for everybody, and not necessary for everybody either. So we'll probably look at the traditional gifting strategies, giving away money while you're still alive. That does have connotations. You do have gifts that you make when you're alive. If you die within 7 years, are potentially liable to inheritance tax anyway, being added back in. So it'll be about putting strategies together to see who's falling into this category. Is it likely to be an issue based on lifespan, making sure they don't spend their pensions too fast just to avoid inheritance tax? And possibly a gifting strategy, we can use trusts and things as well, but trusts are even taxed even worse for capital gains tax than individuals. So we can use trusts, or we can use direct gifts to children, beneficiaries, estates and things. And of course, as an absolute last resort, if people have got nothing, no strong plans, you can leave funds to charity, and charitable donations in your will or from your estate are generally not included for inheritance tax purposes. So if there's no way to beat it, you might as well choose where you want the money to go to, rather than just going to government central coffers. So the other big one in the budget, actually I'll cover a couple of little ones first. First one is that the miners' pension scheme. We're based in the northeast of England, so we know lots of clients who were miners and were members of the miners' pension scheme. It's been an ongoing issue for a long time, where when the mines all went and the pension scheme, thanks to the pension scheme for the miners all went into government management, essentially, the pension scheme made quite a bit of profit, and the government just took that into central profits, which is traditional. They do that with the pension protection fund and things like that. But there's been a campaign going on for a number of years that should be redistributed amongst miners, because unfortunately people who work in the mines often have very poor later life health. A lot of them don't live a very long time into retirement, and therefore the schemes produce a lot of surplus. So going forward, that surplus is going to be distributed amongst the miners as bonuses, etc., who are still receiving the pension scheme, which is what would happen in a traditional pension scheme. So that's just like an interesting aside. There's a change to the regulations for moving your pension to a QROPS, which is a qualified and recognised overseas pension scheme, if it's in the European Economic Area. Again, it's just to close a loophole to make sure people don't get tax relief twice. If you do have a pension in the UK and you move abroad, you can always still access it, dependent, unless you go to North Korea or somewhere, or certain states that don't cooperate. You can pretty much always access it from within the UK still, as if you were here. As a last resort, you don't always have to move it abroad. But essentially, the government have regulations in place, and have done for a very long time, to ensure that if somebody moves their pension abroad, they don't benefit from massively better tax circumstances than they would if it was in the UK. I mean, the whole point of it is basically if somebody has large sums of money, pay them in their pension in the UK, receive a tax rebate on those pensions, and then move them abroad and then take all the money out. So that's what it's always been about, preventing, making sure that overseas schemes have a very similar sort of tax regime to the UK. So they're just closing a loophole on that. But the big one, which you might not think of as related to pensions, is national insurance. So the previous government had a strategy of trying to reduce national insurance. I think um, fundamentally the Tory party had a mantra that they would like to get rid of national insurance entirely. It doesn't really fit with their general ethos. Which I can sort of sympathise with that to a certain degree, because essentially national insurance is just another form of income tax. But it does have nuances that allow them to separate it out from working income tax, etc. So if you weren't aware, if you're an employee on a PAYE system, then your employer also pays national insurance on your behalf, as well as national insurance that you pay directly. So coming up in April, that amount of national insurance is going to rise up to 15% from the current 13.8%. It changes depending on your income category, but essentially that's going up, and the rate point at which it has to be paid is coming down. So there should be a significant amount extra national insurance being paid by employers. Now, obviously, from what you'll really see in the press about this is, of course, this is going to slow down wages growth, because as an employer, when you look at the cost of an employee, you're not just looking at their headline wages, you're looking at what it costs you to employ them. You know, the overheads that they bring to the table, their pensions, their benefits, their national insurance that you pay for them, etc. So it's obviously in the government's interest to slow down wages growth, because we've gone through a period of significant inflation, interest rates are up. If they can slow wages growth, that generally has a knock-on effect to slow inflation and bring interest rates down and maintain interest rates being a little bit lower. But it also can slow growth in the economy. But I said we weren't going to go into that sort of stuff. Let's talk about it from a perspective of what you can take advantage of with this. And there is something. So if your employer operates a salary exchange pension scheme, and if you don't know what a salary exchange pension scheme is, a salary exchange pension scheme basically is, instead of your employer paying you £50,000 a year, you agree with them that they were paying you £50,000 a year and they were paying 10% of your pension. You will have a reduced salary, and they will pay into your pension and you won't. So previously you were paying 10% pension contribution, £5,000 a year, and the company was paying 10% in, they were paying 10 grand, so £5,000 a year. So you're getting 10 grand a year going into your pension. Under the traditional arrangements, both you and the company were paying national insurance on your £5,000 because it was coming through your salary. With a salary exchange scheme, what happens is you accept a reduced salary. Usually the calculation will be done to either make sure that you have the same amount going into your pension and a little bit more take-home pay, or you have the same take-home pay and more going into your pension. But the more going into your pension comes from the national insurance that you didn't have to pay because it was salary exchange. So that national insurance can go into your pension instead, and your employer will pass it on, or they can pass it on to you in the form of better take-home, higher take-home pay. But most employers do it to go into the pension, because that's kind of what the legislation really wants them to do. So it's all about making it easier for you to build up a retirement pot and not become a burden on the state. Now, as part of that, the employer also saves national insurance. Now, some employers choose to keep that national insurance, some put it into your pension as well, and some will split it with you on a certain basis. So if you're already in a salary exchange pension scheme and your employer is passing on national insurance to you, then you probably see more money going into your pension every month once the new rates kick in, because more national insurance is being saved by you being part of the salary exchange scheme on the employer's part than was previously. And if they're passing it along, then obviously you're going to get that in there. Now, if your employer doesn't offer a salary exchange pension scheme, or indeed you are an employer and you have a pension scheme for your employees and it's not on a salary exchange basis, this possibly presents an opportunity for you to change the pension scheme to a salary exchange scheme. Your employees will benefit by getting the national insurance that they save added to their pension pot, so they'll get more money in, and you can opt to keep the employer's saving national insurance, which will have to bring your national insurance bill down, and might have to offset some of these changes, which could be useful depending on you as your payroll. So that's something to think about. And if you're an employee who's been trying to get your employer to switch to salary exchange pension schemes that you can take advantage of this yourself for a number of years. And I know there are lots of people out there who continually ask their HR departments about it, etc. This could be the incentive that they need to make the switch, that they will also save national insurance on doing so. Now, if we look at moving on to property, the additional property tax stamp duty is increasing to 5% from 3%. We did a webinar a little while ago, which again, pretty sure we've got a copy of that uploaded to YouTube. We don't upload them all because sometimes there's things that really can't be put on YouTube. I made the point in that webinar repeatedly that the government, this government, past governments, really want to discourage accidental landlords, i.e. people who move house and because they can't sell their existing house fast enough, turn it into a rental property. And they want to put first-time buyers at an advantage against landlords when trying to buy properties. So this just goes to reinforce that by raising it to an even higher level. There will be some extra revenue raised, but again, it's a further discouragement from people to retain a property when they're moving on. It'll often make it cheaper just to sell it, reduce the price and sell it a bit cheaper. And again, it's meant to put first-time buyers at an advantage to landlords when buying a property. If the landlord's having to pay 5% stamp duty and the first-time buyer is paying significantly less, possibly even nothing, depending on the level of the property's value. Yeah, and in that regard, they're also increasing the stamp duty that companies pay when buying properties, particularly those that are worth more than 500k. Again, this is really being done to make it harder for landlords to buy buildings that they can convert into multiple flats and that sort of thing through a corporate structure in an attempt to avoid additional property surcharges. Traditionally probably the wrong word, but a strategy that some people have used historically is for every time they buy a building, they will, particularly if it's going to be multiple flats eventually or whatever, they will create a new limited company for that building. So that property is the only property that property that takes the property out of their personal ownership, so that they don't pay the additional top up on stamp duty for it. Pay different levels because they're a corporation, etc. But they're clearly trying to tighten that up again. And another one that was a bit surprising, though perhaps not, given that it is a Labour government, is that right to buy discounts are being significantly reduced. We don't know the exact timings on when that's going to kick in. So I would suggest if you are seriously considering doing your right to buy on a council property, and you already have the paperwork especially, you should probably move forward that fairly quickly. Our mortgage advisor can help you with that if you want, but there are plenty of other mortgage advisors out there as well, of course. But as I'm married to Dee, obviously she's the best one in the world, so there you go. Private school, we knew that VAT was going to be applied to private schools. We didn't know at what rate. There was a lot of speculation for quite some time leading up to the election, indeed, with some pundits telling people to pay for 5 years private school fees in advance, etc., to avoid the VAT. Obviously, that carries a significant risk. What if you have to take your child out of school? Do you get a refund? What if the school goes bust? Do you get a refund? And private schools do go bust. I couldn't tell you what rate, but it does happen. I've seen it on more than one occasion. Perhaps more significantly, in April 2025, private schools will have to pay the business rates on their premises. They currently benefit from the charitable exemption. So not just the 20% VAT on school fees, we'd expect to see the cost of private education rising quite dramatically. Next year, full stop. The school fees kicks in January and the rates kicks in April. I mean, I've spoken to some people who work in the finance departments of private schools who think that it might be cost neutral for the bigger schools, because they will also be able to claim VAT back, which they couldn't previously. So on things like if the teachers have car leases, facilities, all the things that the school buys, etc., that they're currently paying VAT on, they will claim that back, and that will offset some of it. But I suspect that when the business rates assessments are done, those will be possibly more significant than the VAT as far as the actual running costs of the school are concerned. But yeah, there's a lot of political arguments around that, which I won't go into because that's not what we do. If you've got a company car, something to think about is benefits in kind tax. They are changing the way that cars are viewed. As I'm sure you probably know, if you've got a company car, for quite a long time, hybrids and electrics have been much lower benefit in kind tax, much better for the company to buy, and much better for the company to lease. Lots of incentives for there. Essentially, the incentives for hybrids are being sort of phased out or reduced or moved in line with ICE, internal combustion engine cars, soon. So fully electrics is the way that obviously the direction of travel is if you want to optimize the tax around company cars. Again, car tax is going to rise in line with inflation. We'll continue with the lowest tax being for electric vehicles. Something that I did notice in the small print, which I think is quite interesting, despite the fact that we're moving towards electric vehicles, the government is investing money and forcing garages to report their fuel prices within 30 minutes of a delivery or 30 minutes of the price changing, which is going to be fed into a database which will be accessible by the public so that you can check where the cheapest price is at all times. I mean, there are already apps out there that do this sort of thing, but they rely on user reporting rather than garage reporting. I just find this one a little bit odd that in a world where we're trying to push people away from internal combustion engines, that this should be a thing. But, you know, apparently it is. So I didn't think it would be something worth investing in. So I'm just going to have a quick look to make sure that there's nothing in the live chat that I should be talking about. But that nobody's been shouting at me that the audio hasn't been working this whole time, etc. Yeah, but anyway, I'll leave it there. This recording should stay up for a little while. If you have any questions, please feel to reach out. And if you want to be notified whenever we put a new deep dive webinar online, there's a link in the description to this video before where you can pop your email address in and we'll let you know. And if you want to look at any of the old ones, as long as they're still current, you will find them on this channel. I had them to a playlist called webinars, but not every webinar we do will just get added. In case I said something off the cuff that could be chopped together and taken out of context. So thanks for your time, and I hope you found this helpful.